Happy Thanksgiving, everyone, to you and your families. My travel day is today. So 2 quick points. The 2 most important days of your life are the day you were born and the day you find out why. Mark Twain. Number 2, the Biden administration says the cost of Thanksgiving dinner is down. Get this, as long as you don't buy any food. WTF. They said it at a press conference, the press secretary. Unbelievable. Unbelievable. I love the spin. So the Fed fund rate is expected to decline by the end of 2024, but not by much, and largely later in the year. So don't get excited. The market experts think the Fed will cut rates 4 times next year. However, from the Fed's meetings and meeting minutes, I am not so optimistic about 4 rate cuts. It definitely would heat up the economy, but only for a short time, in my opinion. Problem with, this is inflation would go even higher. So take the housing market as an example. The prices would go up. I see prices coming down now, for example, with the higher interest rate environment. Las Vegas market, for example. I see good buys next year. I'm following withdrawals, expires. I'm seeing a lot of price drops. So the higher interest rate environment is good for investors with cash and can put a lot down. So I'm going to be doing something 24 in Vegas. So even though the Federal Reserve could still, raise rates one more time in 23, the market remains somewhat ahead of the Fed in the, the magnitude of potential 2024 rate cuts. So if the Fed cuts rates prematurely and pivots, they could ruin any reputation they have left. Remember, it was all transitory. They were saying that for a year and a half, and they were dead wrong. I was saying they were wrong for a year and a half. They basically lied. So, however, any decline in interest rates is expected to be mild compared to the pace of rate increases over the past years. Markets broadly anticipate a 1% decline in the Fed funds rate to between 4 and 5% by the end of 24. Yet, any rate decline is loaded towards the second half of 24, in my opinion, with cuts most likely starting in June or later. But remember, we got a lot of volatility right now with the wars and the markets. Things could change. So the Fed's own projections, they are shared in the summary of economic projections on September 20th. Short-term rates around 5% at the end of 24. As such, most officials see rates declining, but on a slower trajectory than fixed income markets currently project. And perhaps even with one final rate increase still in 23. Keep that in mind. However, that, the forecast period is more than a year out. So both, these estimates encompass a relatively widespread of potential outcomes for interest rates. Trust me on that from the research I'm looking at and people I'm talking to. As is typical, the Fed has scheduled 8 monetary policy committee meetings in 2024 to set the Fed funds rate. Decisions are scheduled on January 21st, March 20th, May 1st, June 12th, July 31st, September 18th, November 7th, and December 18th. So the summary of their meeting held October 31st through November 1st showed that the Federal Open Market Committee members still worry, you think. They still worry that inflation could be stubborn or move higher and that more may need to be done. At the least, they said policy will need to stay restrictive until data shows inflation on a convincing trek back to the central bank's 2% goal. In discussing the policy outlook, participants continue to judge that it was, critical that the stance of monetary policy be kept sufficiently restrictive to return inflation to the committee's 2% objective over time. Maybe turn on our energy that the Biden administration shut down from day one in office, and we would explode. So that was from their minutes. The minutes show that members believe that they can proceed carefully. I like that, and make decisions on the totality of incoming information and its implications for the economic outlook, as well as the balance of the risk involved. So they're saying the right things over coffee and Danish. But like I said, this could change very quickly. The meeting occurred amid market worries over raising treasury yields a topic that appeared to generate substantial discussion during the meeting. The same day, November 1st, when the Fed released its post-meeting statement, the Treasury Department announced its borrowing needs over the next few months, which actually were a bit smaller than the market anticipated. So the Fed's benchmark funds rate, which sets short-term borrowing cost, is currently targeted, I've done a lot of talks on this, in a range between 5.25 and 5.5, the highest in 22 years. Check this chart out, and you can see the graph here. I'm not going to delve into the weeds. It's pretty self-explanatory. Since the meeting, yields have receded off 16-year highs as markets digest the impact of heavy debt-fueled borrowing from the government and views, over where the Fed is headed with rates right now. And, the officials concluded that the rise in yields had been fueled by rising term premiums, or the extra yield investors demanded to hold longer term securities. So the minutes also noted that the policymakers viewed the rising term premium as a product of greater supply, as the government finances its huge budget deficits. Just keep those deficits, baby, keep them coming. Other issues that they talked about included the Fed's stance on monetary policy and views on inflation and growth. So at least they're saying they're going to proceed cautiously. They also said, there was economic growth after a robust 3 quarters in 23. Okay, I got a problem with that. They are admitting, though, it's expected to slow down considerably in 24. The Atlanta Fed GDP Now tracker is pointing to growth of 2% in the 4th quarter. I would challenge, once again, a robust 3 quarters. Of course, the Fed can alter rates. This is key whenever it wishes, outside of the scheduled calendar that we talked about, as it has done previously if you look at precedent during times of economic stress. Still, I think absent severe economic news, the Fed will likely stick to its 8 decision schedule, at least for the 24 year. The more significant meetings may come, I think, in the spring, like June or March, June, and then in the fall. So nothing's going to happen early, when they're talking about their economic projections. So it seems likely that interest rates will move lower in 24 on current projections right now. But like I said, they could change very quickly. But the bottom line is it's going to be not by much, and not until later in the year, in my opinion. The prospect, of a recession could change the picture, but it's not, like a base case for current forecast. Let me just say this. We've had 2 consecutive quarters of negative growth. The Biden administration said, that's not a recession. But it's happened 10 plus times since World War II, and it's always been a recession. So I would argue we are in a recession. That has been the benchmark. It's always been right, and it's right now. And they're trying to finagle these numbers not to freak out Americans, or remember it's an election season. The unemployment rate is not 3.6%. Over 60,000 jobs were lost in the tech market early in 23. Those are 6-figure jobs. They're counting part-time jobs. I don't want to get into this, but that is a wrong forecast. You have 150 million people in this country that only have $500 in their savings account out of 330 million. That is not a healthy, robust economy. Okay, we got inflation at 41-year highs, and it still is. And it's higher than they're saying. And I'm just let me just revisit this real quick. The Las Vegas market, okay, I'm licensed there and all that stuff. And Vegas market, and I own there with another guy, but I'm going to buy something next year. And I've been following it for 5 months now, just really closely. Looking at withdrawals, looking at expired listings, and talking to investors there. A lot of the homes there are spec homes. More than 50%. Speculators bought them, they're empty. I like Vegas because you got Oakland A's coming in. You got the football coming in. Conferences are back. I like the tax system. A lot of companies are moving in. But Vegas is always volatile. You look at a 10-year trend line, everything always hits there first for the West Coast. So I'm just going to say, for example, there's a house I'm looking at. It's 1.6 million. It's already down to 1,450. Across the board, there's price cuts in the 6 figures. So Vegas lost all its price gains in 2022. And in 23, it's down 14%. In 24, it's going to go down double digits. You know, inside realtors aren't going to tell you that. I'm telling you the truth because I do 5 things. I'm first and foremost an investor and a developer that we're doing, not selling and buying and selling real estate. It's one thing I do to learn about the markets and get multiple licenses in multiple states, but it's not my pride and joy, but I study the hell out of it. So because I got other revenue streams going, I'm going to be more likely to tell you the truth. So yes, inventory is low, and I just did a talk on this, and inventory is low. But when you look at regionally, you're seeing foreclosures, you're seeing the rates and a decline, and you're seeing a decline in prices in certain markets. I think Vegas is going to be a good buy for investors. Remember, a lot of investors are sitting on cash right now. They can put a lot of money down. So in an interest rate high environment, it's good. If interest rates go down, prices of homes are temporarily going to go up. So, you know, what got us into this mess in the first place is 2% interest rates for 10 plus years. Interest rates should be 10%. And it shows how volatile this economy is when Americans can't afford a 5 to 6% interest rate. They're freaking out. They can't afford it. Americans aren't putting 50% down on homes. 30%. They're freaking out. That shows, in my opinion, the economy is unhealthy. Maybe it's because we give all this money to foreign countries and we don't take care of our own. That's part of it. But I mean, the interest rates move 2-3% and people are freaking out. That's not a healthy economy. So from an investor perspective, I hope the rates stay at 6-7% because I'm seeing massive price drops in certain segments in the United States and abroad. And there's going to be good buys coming up. You're sitting on cash. There's going to be good buys for multifamily, single family. And I'm seeing it. So, and I followed just certain markets, and Vegas was just one, but I'm seeing it in Boise, and Boise was down 31% after COVID, you know, Coeur d'Alene. So it's interesting, but don't get too giddy about the rate reductions in 24. It's going to happen the second half of the year, but we have a lot of volatility in the global markets right now, and things could change quickly. That's the second point. Things could change very quickly with what's going on with the interest rates. Take care.